I remember I made like 1,000% a couple times in those options. So I just thought I was the genius. I borrowed money against my credit card, got the cash advances, and sent that money in, $25,000 in, and opened my account at Generic Trading.
Today, we sit down with Brian Shannon, a professional trader for over 35 years. He's the founder of AlphaTrends.net, author of 2 influential books in technical analysis, and the godfather of the Anchored VWAP.
I was a believer in positive earnings surprises. It was such an easy pitch. And the analyst was expecting this. Do you know what they did? No, you don't know what they did. They did 10 times that. And the revenues were up 236%.
How would you describe your objective as a trader in a few sentences? How do you describe your overall style?
So my overall style is swing trade with the trend using multiple time frames. My key tools are simple moving averages and the anchored volume weighted average price. I never try to fight the trend. Every time I do, I seem to get burned. You got to do it at some point in your life, bet on yourself. And the thing is, I was too naive to be scared. I just believed it was going to work. Don't argue with the market. Look at the market and manage risk.
Did you have any major trades that were setbacks, big losers?
Just had my first son. My wife was pregnant with our other son. No other source of income. This was my life savings. And I was trading a stock called Chantel Pharmaceutical. I had my account up to like 27,000. And then
Hey everyone, welcome back to another episode. As always, we bring top traders, US investing champions, and market wizards here onto the show to share their journeys, their strategies, the mistakes they made throughout their careers, and key learnings that they want to pass on to you guys to save you time, save you money, and improve your performance. We've been lucky enough to hear back from many viewers over the past few years about how much of a positive impact this podcast has had on their trading journeys, and we're incredibly grateful for all the support. If you're looking for a free, quick, and easy way to give back to us and show us some goodwill, please double check that you're subscribed down below. And if you aren't, go ahead and click that button. And with that said, thanks again for your support, and sit back, relax, and enjoy. All right, welcome back everybody to the TradeLion podcast. I'm your host, Richard Moglen. This episode is brought to you by DeFi Charts. Check out the link down below in the description for a special offer and to check out the new DeFi AI. Joining us today on the podcast is Brian Shannon, professional trader and the founder of AlphaTrends. He's also an author of 2 excellent books that we'll get to very shortly. And he's the godfather of the Anchored VWAP, which we'll get into as well. Brian, a real pleasure to be doing this with you. Thank you so much for taking the time. And yeah, looking forward to this. Welcome.
thanks for coming out to Denver and make it happen.
I'm happy to. And we were maybe getting hit by a fluke snowstorm the days that we're recording this, but everything worked out. So it's all good. To start, Brian, I'd love to kind of bring it back all the way to the beginning. And was it your father who first got you interested in the markets? Can you tell me a little bit about that story and how you first got interested in the stock market? And I don't even know if trading at that point, more investing, what was kind of going on there?
I really was never an investor. So, it was through my dad. He would watch Wall Street Week. I'd watch that with him. And when I was about 14, I think, there was a company on the local news, LoJack. It intrigued me. I was a hustler when I was a kid. I was caddying newspaper routes, selling gum in school, selling candy and, all that stuff. So I had some money saved up and I said, "Hey Dad, I'd like to buy the stock in LoJack." He goes, "Great idea. It's $5 a share." I said, "Cool. How do I buy 100 shares?" He said, "We'll buy 1,000 shares at $5." And in the next 3 months, it went up, it doubled. So he gave me the leverage, basically 10-to-1 leverage. And I was hooked right then and there. That was my first trade ever. It was 3 months, which is still on the longer side of my average hold today. I still work on that. I want to be a longer term holder and I do some with indexes, but for individual stocks, that's kind of long term for me. So with that first one, I was hooked. It was right then and there. I knew that's what I wanted to do.
Was he a trader or investor, or he just was kind of willing to help you out and get you started?
Yeah, he was a physician, so he would just be a casual investor, really. But he got me interested. So
cool. And from that point, did you keep making trades? How did you transition from just getting interested into it to finally making this a career? I know you started, getting involved with prop firms, starting your own trading desk out here in Denver. Maybe take me through that progression.
Sure. I had a couple little trades in between that really didn't add up to anything. And then right out of college or during college, I was kind of dabbling again. And I was reading the Cabot Market Letter, which is still around today. And they had a number of successful stocks. And there was another one that I think was $5 or $6 a share. It was called Advanced Polymers. And I don't remember what they did, but it was APOS was it?
Something with polymers.
Yeah, and it sounded cool. I think what they were trying to do actually was to make these like basic little mini sponges that go into gum to make the flavor last longer, which sounds like just awful in terms of digesting it and microplastics and all that stuff. But we didn't even think about that stuff back then. So that one I also had, really good success with in a short period of time. I sold that pretty much as I was graduating college, and then got a job as a broker at a little brokerage firm called Thomas James in downtown Boston. Stayed there for about 2-3 months. It was basically a bucket shop. I mean, it was crazy what they were charging people for commissions with, the bid and ask spread and hiding, big commissions in it. So I got a job at Lehman Brothers in Boston. Started out as a cold caller. Actually, the way they start you out is they start you out as a dialer. So you just have dialer. You have two phones in front of you, and you would just dial the number. And as soon as you have a live person, the person on the card in front of you, you say, "Mr. Mogul, I have a call for you. One moment, please." And then say, "Line 2." And then a qualifier would come in. The qualifier would say, "Mr. Moglen, we understand you're involved in the stock market. Tell me a little bit about yourself. I want to, come back to you once or twice a year with an excellent idea. What are you typically growth in, income?" So then that person would qualify the lead, and then they would give it to an account opener, or that person might be the account opener as well. So 2 weeks later, they call back, "Hey, we got a great deal for you. You'd never believe what a good idea this is." And then try to open the account. So you had to do a minimum of a $10,000 trade. And this was 1991. So right out of college, it seemed like a ton of money to me. And I wasn't the best salesman. I was okay, but I wasn't comfortable asking for like $100,000 orders and $250,000 orders. That came with time, which, it just starts to more normalize. Um, and then, once you succeed as a dialer, you get to be the qualifier, the account opener. And then if you open 10 accounts a month for $10,000, 3 months in a row, then you become a Lehman Brothers broker. And it was just a cold call operation. I mean, it was just all on the phones all day long. So I had months where I did 12, then I did 9, and then I did 11, then I did 7. And I was like, I'm never going to get 10 in a row. So I went to a different brokerage firm, Tucker Anthony, stayed there for about 6 months, and then moved to Denver in late 91. So then I, worked at that was prior, Dane Bosworth here in Denver. Worked for them for a year and a half, 2 years, and then started as a prop trader at Generic Trading, which is Carlin Equities, which I don't think either of them still exist, but they used to advertise in the back of IBD saying 25-to-1 leverage or 20-to-1 leverage. You need $25,000 to start. So I quit being a broker, had saved my money up, quit being a broker. There was a good story actually in there about getting the funding for that.
Yeah.
And then, was a broker. Traded with them for about 2.5 years, and then started my own brokerage with Landmark Securities in downtown Denver with with a partner at that time. So out of that, I created a technical analysis class because we would get customers in, they wouldn't know what they're doing. So I said, well, we'll do a class. And that kind of got me interested in, teaching. And I realized that was kind of a natural at it. People always gave me good reviews on it. So that firm got bought out by another firm that called MarketWise. And at MarketWise, I became their head of prop trading, and also their head of. I started as head of education and a trader, so I traded their money. And then they had a prop trading department that the guy who built it didn't know what he was doing. So that became one of my responsibilities as well. And that lasted about 5 years, I think. And that's where I first actually started doing videos, recording, doing screen shares and that sort of thing. So that was probably about 2006 that wrapped up. And then I went to, I just did my own thing. I was just trading and uploading videos to YouTube because that's what I was doing.
Well, before YouTube, we were talking about this earlier. It was 2 years before. It was a Google video, or
It was Google Video, and Google, before Google bought out YouTube for what seemed like an ungodly sum of money back then, which they've just made so much money on. Um, so yeah, I just was doing that on a daily basis, and the audience kept growing. I didn't have any plans for what to do with it. And then Howard Lindzen at StockTwits contacted me and said, "Hey, Brian, do you want to start a subscription product?" I said, "That sounds great. I don't know how to do it. That's why I haven't done it." So they handled all that, and that was kind of the birth of AlphaTrends as a subscription. I had alphatrends.blogspot.com, which was a free site where I was just, kind of getting my name out there. I really didn't have any plans with it.
and you've got some blogs from way back in the day of concepts that we'll talk about today that you're still using, like the gap up, wait for the reclaim of Anchored VWAP. But we'll talk about that. When did you start using technical analysis? Was that from the very beginning, or did that kind of evolve as you gained more experience and kept learning and who kind of took you under your wing, if so, or was it more self-taught that you kind of developed your style?
Little both. So at the first trade, after college was that advanced polymer, and in the Cabot market letter they always had a chart. They said buy it if it gets above $5 or $6 a share. I don't remember the price. And I thought, wow, why would anyone want to pay more? And then you look at the chart, and it made 100% sense. Why? You could just look at it and say, well, it's never been above that level, so everyone's winning. Like, who would sell? It doesn't make sense. So that kind of piqued my interest. Then I decided I need to learn a little bit about this. So I would always be going to the bookstore and reading Money Magazine and Kiplinger's and all this stuff. Then I found Stan Weinstein's book, Secrets for Profiting in Bull and Bear Markets. And that really was a light bulb moment for me, to see that cyclical flow through the market. And that really just kicked off my passion for technical analysis. It made complete sense. I went from that book to John Murphy's book, which is more like traditional pattern analysis. And then I would just pretty much devour you saw my bookshelf.
Yep.
Devour pretty much anything I could find on technical analysis. So when I was at Lehman Brothers, that's when I first, I had been reading the IBD at Thomas James, but at Lehman Brothers, I first saw the daily graphs chart books, because the broker I worked under, his name was Michael Collins, and he kind of taught me to blend the fundamentals and the technicals. Now, I definitely veer much more towards technicals, but he was all about positive earnings surprises. That's where I learned that. So a big catalyst, the earnings, up on big volume, and post-announcement drift. So, the things that still work today and still drive large institutions. So Zacks was the big earnings company back then who would, they would tell you what the earnings surprises were. Now it's like just all right there 10 seconds later. So Mike Collins taught me, he didn't teach me so much, because he was kind of a rough boss. He was just like, get the shit done, and, we don't discuss it. Just do it. But I, was curious. So I was like always leaning over, and, he'd go to the bathroom. I'd go rummaging around his desk, looking at what charts he's looking at, because he wasn't always telling me. So, I was kind of sneaky about it, but out of intellectual curiosity.
Hey everyone, just want to jump in here real quick and let you know that this episode is brought to you by DeepView, which is the platform I use every single day to find new trading ideas, monitor existing positions, identify new leading themes, and analyze the markets. You guys deserve a platform that keeps innovating and brings you the most up-to-date tools to trade the market. And at DeepView, almost every single week, we're launching a new feature or system update. Here's what makes DeepView different. The screener comes loaded with preset screens from actual market wizards and top traders. So you're starting from the setups that the best in the world actually use. And when you're flipping through results, you've got mini charts right there, so you can visually scan through hundreds of stocks all at once. That alone saves me so much time every single week. The charting is built for how we actually trade. Multiple time frames, unlimited indicators included Anchored VWAP, enhanced volume, custom indicators like RMV, and the built-in RS rating. You've got custom dashboards to track the market, themes, and real-time sector rotation, so you always know where the money's flowing. Best yet, we just launched the DeepView AI terminal, which brings all your research into DeepView with easy-to-use preset prompts or your own custom ones. You can even identify gap catalysts with just a right click. We set up an exclusive offer of 1 free month for all TraderLion podcast listeners. So to activate your trial today, check out the link down below in the description or visit deepview.com/podcast. That's deepview.com/podcast. And with that, let's get back to the interview.
Excellent. And did you, throughout this whole progression, did you have any major trades that were setbacks, big losers? Maybe at that point you were risking, a much larger portion of your account than you do now. Any significant drawbacks that kind of taught you a key lesson, or you remember, because we always remember the bad trades more than the winners for sure.
Initially when I was at Lehman Brothers, I was just like in this magic zone, and it was EMC, which isn't a company anymore. They were data storage, and EMC was a red hot stock. I mean, it would go from 1920 to 30, 35. It'd split 3 for 2, and then it would do it again 3 or 4 months later, just like 6 splits in a row. And every time it split and it started to settle down, I remember I was always buying the 2250 calls, and it was EMC X, whatever X was a symbol. CX was March X, because you only had monthly back then. So A was January, B was February, C, and then X was 2250. I remember I made like 1,000% a couple times in those options. So I just thought I was the genius. And I was doing, and I learned a lot, and some of Mike's picks as well. Unisys was a great one. Unisys was, I think it was about a $7 stock, and it went to 12. And I bought common shares of that, did well. And that kind of really, so I was making more. So at the Lehman Brothers, I was making $5 an hour. And if I opened a $10,000 account, I'd get $100 bonus. So the most I was making was $1,000 per, 12, I think, for 13 was my highest. 1,300 for opening 13 accounts and $5 an hour. So I was making a lot more money in the market. So I really didn't work so much on my sales skills.
Yeah.
I would,
because you wanted to be a trader. That's what you were there for. Yeah.
exactly. So I was like, man, I don't want to just bug people on the phone, get hung up on all day long. And so, I would steal where he'd be done with his IBD book, and I'd take it out of the trash, bring it home, and just pore over it or look at every little detail. So that really, got me hooked. And I didn't have my bigger, I didn't really have my bigger losses till I almost went out on my own. But as a broker, what I learned was there were stocks that you could tell your customers about, and there were stocks you traded for yourself. And they, so the higher octane stuff was more like, oh, keep that to yourself because you could blow your customer up. But even the so-called safe stuff, I used to kid around and say, I got to practice with other people's money. And basically as a broker, I did. And it wasn't, negligent or malicious, but I got to practice with other people's money, and they would trust me to give them a good idea. And I would not always recommend what the firm was recommending, at Dane Bosworth in particular, because I was a believer in positive earnings surprises, and it was such an easy pitch. And the analyst was expecting this. Do you know what they did? No, you don't know what they did. They did 10 times that, and the revenues are up 236%. What do you think's going to happen to the price of this stock? Exactly. That's why you're in for 1,000 shares. Okay, let's do it. But then a couple of those, I, mistimed them. I didn't realize I was buying extended, and, hurt some people. Not like bad, but, hurt them. I mean, if I was the customer, and I felt bad, but, that's just the way life goes. So they would lose some money. I'd feel bad about it. And I think, I really don't want to do this. So I kept looking at that back of the IBD. And I was trading in aggressive stocks. So I had maybe, I don't know, like $12,000 in an account at that time. Just had my first son. My wife was pregnant with our other son. And no other source of income. This was my life savings. And I was trading a stock called Chantel Pharmaceuticals, which was a wrinkle cream company. And I was, trading it really well. I had my account up to like 26, 27,000. I put in my notice, said 2 weeks, I'm done. I'm going to go be a trader. They all thought I was nuts, which was probably true. And then, so on a Friday, I took a Friday off of work. Was it? No, I went skiing that weekend and took a Monday off of work. And, I didn't have quotes. We didn't have the laptop with quotes on it at that time. This was 1992. So I called the office, my assistant, and said, hey, give me a quote on CHTL. And I think it closed the weekend at 24. She goes, it's 16, 16 and 3/4 or something like that. I'm like, no. CHTL. She said, yeah, it says there's news. I was like, I was just irate. I just put in my notice and I had, the clock was ticking. I had, now 9 days left. So Barron's did a piece on him and said, it's not a pharmaceutical. It's not an anti-wrinkle cream. It doesn't work. It's just complete bullshit. So I sold that stock, had like maybe $13,000 or $14,000 left. And, I did a couple little trades, maybe made another $1,000, $2,000. And then my notice was in and I didn't want to say, oh no, I want to still be a broker. So I borrowed money against my credit cards, got the cash advances and sent that money in, the $25,000 in, and opened my account at Generic Trading.
It's not financial advice.
But it's definitely financial advice. But you know what? In a way it is. In a way it is, because when you're young, right? I was 24, I was 25 years old. You gotta take that kind of risk at some point in your life. If you're 60 and you just retired and, there's your nest egg, now you're going to go for it, you put 10% of your money aside and trade with that. But you got to do it at some point in your life, bet on yourself. And the thing is, I was too naive to be scared. I just believed it was going to work. So, with that Chantel Pharmaceuticals trade, it gave pharmacy. It wasn't a pharmacy at all. The name still cracks me up. With that experience, it really taught me about risk management. So here I put up 25 grand, half was borrowed. So half stock, half cash. People know what that means. Yeah. And then all of a sudden I had an account with access to 20-to-1 leverage. And, so I started trading it with some leverage, maybe 2 to 4 times leverage, but I don't think I ever went the full leverage. It just, I couldn't. I was too afraid to blow up. So I was making money, nice and steady, consistent, nothing big, 2, 3 grand, sometimes 7 on a good month. And then I had the opportunity to, I became friends with the owner, Ron Shear, and said, we need to open an office in Denver. I've got these guys who have an office, so helped them open an office. That didn't work out for me because they raised my commissions. They kind of squeezed me out. But Ron was a true gentleman and he, set me up and, gave me a piece off the side for setting them up. So I worked with them for a couple months and then started my own brokerage, my own office, not my own brokerage. So I had been Series 7 licensed, and then I got my Series 24, which is branch manager. So I could bring traders in and let them trade. And that's where, I started the class and we had the big 22-inch cathode ray tube monitors. So that was kind of how I really got started in full-time trading.
Nice. And flipping the page a little bit, looking back on all the books that you've read, like you said, you love to dive in and learn wherever you could. what were some of the most meaningful, or what would you recommend traders, I guess, watching this start with? And I know you brought some from your library here, so maybe walk us through each and give a brief description and why you think it might help a lot of folks out there.
Okay, number one, most influential in my career, Stan Weinstein's book, hands down. You can see the influence in my first book all over the place with that. And Stan's a true gentleman, and you know that as well. And then, as far as combining fundamentals and technicals, William O'Neill, How to Make Money in Stocks. After that, Reminiscence of a Stock Operator. That one was kind of open your eyes to what real speculation can be, and really going for it. But it also, to me, the biggest lesson in this book is risk management, because he blew up over and over again and finally couldn't take it and took his life. And I said, well, yeah, he's not my hero. I mean, heroics for trading, tons of wisdom in the book, but as far as a hero, the guy was a disaster.
He needed to go fishing and go skiing a little bit, I think.
Yeah, absolutely. He was just kind of a little unbalanced, I think. And, they should make that into a movie, by the way. I've been saying that for years. After that, I picked up this book. Well, not in order, but what's it called again? How Charts Can Help You in the Stock Market by William Giler. And the thing I like about this book a lot is it goes through the patterns, it goes through a cup and handle, the ascending triangle, but it goes through supply and demand, and it goes through emotion. What are the participants thinking? So it really delves into the psychology. And that was really an eye-opener for me to kind of, as Keenan and I, who've done a couple articles, and we've got another project we're working on, wrote an article called Humanize the Charts. And that's just understanding that it's not just a cup and handle. It's not these squiggles, this inverted head and shoulders pattern is not just the pattern. It's lower high and lower low, followed by a higher low, then a higher high. That's it. It's just a simple trend change. So I love that book for that, because it really opened my mind into saying, okay, these are human emotions represented, the aggregate psychology of the market. And then a more recent book, The Perfect Stock,
Taser, right?
by Brad Cuttashore. And this is about Taser, now Axon. And the thing that really struck me with this book is I was trading Taser really aggressively during this run, and how a 7,000% move was set up, started, and finished in an astounding 52 weeks. I remember it specifically because I was making a lot of money with it. And then I made some mistakes with it, because Taser was at that time, and now I like to say there's no such thing as up too much if there's still buyers. Well, I thought it was up too much at a certain time. So I would try to short it, and there were never shares available to short. And I saved a lot of money through that. But then I got so clever and found out there was TASRW, and they were trading in parity because they were in the money, and you could borrow the warrants. So I made a couple trades short, made, a few grand here and there. And then one time I held on too long, and, it was a bigger loss. Then it was bigger than the loss. It wasn't bigger than the aggregate that I made on the upside. So let's say I made an aggregate 100,000. I might have lost, 40 or 50 shorting the warrants, which was just stupid, because that was pretty much all in 2 or 3 trades. Whereas on the way up, it was maybe 20 trades. Yeah.
Were you swing trading Taser, like a similar style to what you use now, or okay?
I held things a little bit longer even back then. And it might partially because the technology wasn't still as advanced. I didn't have 1-minute charts to invent things on. And daily VWAPs, that was prior to VWAP trading for me. So it, so in some ways I'm just kind of thinking, the technology has ruined a part of that, making it too accessible. So there's always that balance, and, I'll still hammer out day trades when I see them, like, can't resist. But I like to be a swing trader.
Yep. And speaking of like technology, changing things a little bit. When you were talking about the daily graphs charts and flipping through that book and taking it out of the trash and studying it, I recently did an interview with Jim Ropel, and in his basement, he has stacks and stacks of those daily graph books. And I've never really looked through them. And it's just a different experience to look at charts, study charts, pen and paper versus on charting software and flipping through. And probably there's a lot of lessons that you probably notice the details even more because you have to study one chart at a time and more intimately than now we can just flip through hundreds, in a few minutes. So.
Yeah, so it would be, I would flip through the books, create my watch list, and then there were 4 per page. So there were, the charts were this big. And then I would cut them out. I'd use a little X-Acto knife and then go to Kinko's and then blow them up at 250 times. So it was full size. And then I would have maybe 20 that were my watch list for the week. Now I have 20 that's my watch list for the day, 75 for the week or, 100, whatever. So it did concentrate you more. And I would each day look at those stocks and I would draw, at the end of the day, I would draw the new bar in and stay focused on it that way. That really,
It teaches you something.
yeah, it really personalizes it more, even more so because you're writing it down and you're, building the chart. You're part of it.
Yeah. Excellent. Well, Brian, I'd love to dive in now more into your trading style. And there's a lot to unpack there. We're going to cover rules. You prepared some case studies that we're going to go through as well, which will be great. But maybe just to start with, how would you describe your objective as a trader in a few sentences? How do you describe your overall style?
Okay, well, I'm a swing trader, swing trend trader, I guess you could say, because I never try to fight the trend. Every time I do, I seem to get burned. But I still try once in a while.
We got to remind ourselves.
Yeah, we got to remind ourselves. And that's why I always say, you do dumb things, you get what you deserve. And it's true. I see people buying a stock, up 30% in 2 days. Sure, it could work, but don't be surprised, in these stocks with, 20% ATRs. And people are surprised that the stock goes down 10% in a day on them. It's like, well, that's half its average. What did you expect? Do you actually know what you're trading? So
Bring you back to your overall style.
So my overall style is swing trade with the trend using multiple time frames. My key tools are simple moving averages and the anchored volume weighted average price. My secondary tools are pivot levels. I do a little bit of Fibonacci and a little bit with volume, but really volume is more tied in with the VWAP, so I don't really rely on that much. Multiple time frames and trend alignment.
Excellent. And we're going to dive into each component of that. So that's awesome. To start with, volume weighted average price. This might be an entirely new concept to somebody watching this. And we're going to get to anchored volume weighted average price next. But what is volume weighted average price? How would you define it? And how is it calculated on multiple timeframes?
Okay. The volume weighted average price is basically the dollar cost average of every single share from a certain period. So if your daily VWAP measures from the very beginning of the day from 9:30, what you'll see is that first trade is 100 shares at $25.76. That's the VWAP right now. But obviously you've got 50,000 trades behind it. So it's a cumulative average. It sets, its anchor point for a daily is on that very first trade. And, on a 1 minute bar, you'll see it going up and down as the volume moves. And then it gets locked onto that 1 minute bar. And then if the volume starts coming into it and it goes sideways, well, the line will just go sideways. It'll say, basically, we're neutral in here. But if we start to see the stock starts to rise and there's sufficient volume, it'll drag that volume weighted average price higher, saying the average transaction price is rising here, meaning the buyers are in control right here from this period of time. This might be 6 minutes into the day, but for these first 6 minutes of the day, the buyers are in control. Then let's say it drops below the VWAP. So it might have gapped up and it runs for 6 minutes, then it drops below the VWAP. Well, all the people that chased it in those first 6 minutes are now losing money on average. Not every single one of them, of course, but on average. And we want to know what's the average participant thinking here.
It goes back to the psychology aspect, thinking about what different participants are doing. If they bought it, it rose, and then now it's dropping below their costs, they're hurting.
They're hurting, right. And by the same token, we have short sellers. And the short seller says, this thing's gapping up. This is a piece of garbage stock. We're going to short. And they take some heat initially, but now, hey, we're in control. So they put 15,000 shares on the offer to scare people into saying, okay, well, I better hit the bid now. And then another person says, oh, that 15,000 shares stepped down. Now, it drives it lower until maybe it levels out 15 minutes later. And then it crosses back up above the volume weighted average price. So this is what I call chase the gap or wait for VWAP, is what we're building into a strategy as well. So the stock gapped up, it, ran for a few minutes, pulled back, then it gets back above that daily price, average price, 22 minutes into the day. So that's where I love to buy gaps, because at that point it says, okay, we had an event. It might have been an earnings report. It might have been an upgrade. It might have been just nothing, who knows? Maybe their competitor reported earnings, or just the group is hot. So all the rocket stocks are going, this one's going too. It's pulled back, it's back above VWAP. Now I want to get involved in this hot group. So it starts to rise a little bit, stop underneath the low of the day, and 60% of the time, it won't violate that. 40% of the time it will, but it's a real nice tight stop. And I'm making those numbers up, but I'm saying the majority of the time, it does continue, especially when you have a clean chart, with a stage 2 uptrend on the bigger time frame. So then to start, managing that, and what you'll see a lot of times during the day is that the buyers are in control. And, the buyers, the institutions who want to buy it will give their order to Goldman Sachs. Goldman Sachs will say, oh shit, the stock's gapping up. We need to drive this thing down. So they'll short some shares to try to drive the price lower, short 50,000 shares so that maybe they can buy 200,000 shares at a lower price. That turns that VWAP sideways. And now people are starting to say, hey, the buyers are gaining control here. And now Goldman is long 150,000 shares near the lows of the day, if it continues to follow through, out of this million share order they have to fill. So throughout the day, what you'll often see is that strong stock. It'll rally up. It'll, here's the VWAP. It'll run up. It'll pull back down towards that VWAP during the day. It just magically bounces from it. It'll do it 2 or 3 times a day sometimes in that same stock. And I don't like to buy the pullback to the VWAP because sometimes it'll fail, right? So I'm starting to think, protect my profits from chase the gap entry, or maybe I've sold a little bit because it hit daily R2 or daily R3. And then, when it, not necessarily if it hits those, but so on an intraday trade, if it gets to daily R3, let's say, because I bought it already a little extended, that's my cue to say, this could be where sellers show up. It's a level of interest. So I'm not going to sell it just because it hit this pivot level. That's foolish. It might run right through it like it did R2. So instead I look at 2-minute bars. And as long as each 2-minute bar shows a higher low, I stick with my first third. But as soon as it breaks a lower 2-minute low, then I sell my first third. I don't care if it keeps going higher. That's not the goal of that. The goal isn't, hey, I'm going to buy this and hold it till next quarter's earnings. The goal is I'm taking some risk off. I'm in a position of strength. So then if the stock, let's say, what do we say? It was 27 when I bought it. Let's say it was to 28.75. I sold some at 28.70. It pulls back to the VWAP at 27.86. It'll maybe stay there for a few minutes. Maybe it drops below it a little bit. Start thinking, oh, maybe it's not going to hold. But then it firms up. And then as it starts to bounce from that, I'll buy back that third that I sold. So now I'm back to a full-size position. On that third that I just bought, my stop is maybe 20 cents away. It's below that low of the bounce. So, undercut the VWAP by 10 cents, gets back above. I buy it 15 cents higher. My stop is 15 cents on that.
Yep.
And on the 2/3 of the original position, I can look at it as either, well, now I have a new cost basis, or that money is different than this money. So I start to manage the trade like that. And typically by the end of the day, I'm either going to sell that add-on, or if it closes really well and it was, let's say, an earnings gap, and they reported earnings of 25 cents versus expectation of 18 cents and last year's 10 cents, whereas we're up 238%, I'm most likely going to hold that. And I'm going to keep that VWAP from the event on there for, sometimes it will hold above it for the next month. And ideally, I'm going to hold at least a portion of that for that month. And if it breaks below it, that's my cue to get out, because now the average person over that month since the event is now in a losing position. The sellers have the opportunity to take control. I'm either going to get out on that break, or based on the definition of trend, higher highs and higher lows. If it makes a if it makes a lower low, not on 2-minute bars, but instead on 30-minute bars, and going back the last 15 days, the higher lows, those little pullbacks, each one is successively higher. It breaks that, then I'm going to get out.
And the beauty of this is, for those of you watching who maybe their time frame is a little bit longer, you can extrapolate the same logic you're using to the weekly and daily chart. It's fractal.
It's fractal. That's the beauty of technical analysis. So what I just did there accidentally was just, talk about strategy as well, because just talking about the VWAP itself is kind of boring. It's okay, what do you do with this thing? Because it says the average, and you'll see that a month later, a super strong stock, a month later, it'll pull back to that VWAP and it'll bounce from that VWAP, because there are programs, there are buyers that are saying, I want to buy this stock for the next 3 months or the next 2.5 months until we have visibility on the next earnings report. We want to buy 10 million shares over the next 10 weeks. So roughly 1 million shares a week. As it pulls back to the daily VWAP, they're defending that. If it pulls back to the 2-day VWAP, or the week to date or the month to date, or since the earnings, then I'll look at that stock again and say, all right, I already took my profits. Now it's back to the anchor from the earnings. And that earnings was 4 weeks ago. If it holds in here, I'm going to look to buy the bounce from that. But I'm not going to buy the touch. There's a big difference.
Yeah. That what you just said there made me think of Fastly, which back in Feb 12, 2026 had a large earnings gap, very strong. And then if you anchor a VWAP to that point, on April 14th, we had an undercut of that anchored VWAP. It also coincided with the 50-day moving average. So you had multiple levels of interest there, and it responded. It built a little bit of a structure there, mini base, and now is back in a shorter term uptrend, expanding higher. Is that kind of fit, pretty good example of what you were just...
It does perfectly. And actually, if you look at that, Richard, and you put a year-to-date anchor on that, it undercut the anchor from the earnings, but it nailed the year-to-date anchor. So some people could say, hey, I bought the 50-day moving average, and that's great. And I wouldn't have bought the 50-day moving average. I wouldn't have bought the anchor from the earnings, and I wouldn't have bought the anchor from the year-to-date. That's my cue to say, okay, we've got the year-to-date anchor, the earnings anchor, and the 50-day moving average. These are levels of interest. Why? Well, because the average participant from the beginning of the year is now going to be in there defending this stock. Since the last earnings report, they're going to be defending it. And the stock dropped super hard from 35 to 22. So why did that stock drop? Because there was some profit taking initially, and then it became panic profit taking. So the panic profit taking, they might have sold at an average of 27. They see it down at 22. They're like, hey, we really like this stock. We're going to buy it because it's at the 50-day. We're going to stop selling it because it's at the 50. We're going to stop selling it. Another group says we're going to stop selling because it's at the year-to-date anchor. Another group says we're going to stop selling because it's at the earnings anchor. Then sideline cash says, hey, it's at those levels. I'm going to start to stick a bid in. And then you've got the shorts who start to cover there. So it all comes together. So why are these people in there? Is the 50-day moving average magic? No, but we all use it. We all have it on our chart. So we use that as a reference point of value. When it pulls back that hard, we say, let's look for evidence there's buyers in there. There's levels of interest. So I let other people do what I call the dirty work of risking their money and buying the plunge. Because if you know, even if you look at that, it touched the 50-day moving average that day at 2150 and it went down to 2068. And when you buy it at 2150 and it's dropping to 2060, yeah, it's only 90 cents, but it's in free fall. And all it's been doing for the last 7 days is go down. You start to feel that uncomfortableness saying, oh shit, it's not holding the 50. Maybe I need to get out. So I don't like that type of uncertainty. I'd rather buy it $2 higher when I see that it's back above the 5-day moving average. It's made its higher high, and I know I can risk. Now I have a higher low as well. That's maybe 75 cents away. I don't need to go through all that stress. That's the part about trading that I dislike. So I really concentrate on my entries for that reason, is because I like to be right from the start, have the wind at my back. Buying in the hole just never makes sense to me. I can't do it. Every time I do, I puke them out.
Yep. And you mentioned the 5-day moving average, and we're going to come back to that. So you got to keep watching to get to that tidbit there. One more thing about this Fastly chart is I love the first test of the earnings gap Anchored VWAP, and that happened right Feb 23, Feb 24 as well. We've got a little bit of undercut and rally of that level.
7 days later.
Yeah, sorry, go ahead.
7 days later, yeah.
Exactly. And yeah, it's just a spot, a swing low, easy to manage risk against. And this didn't fall through immediately, but it consolidated a little bit and then had a slight gap down on Feb 27 and then pushed off. You've got the 10-day moving average coming up as well. 10 EMA. You might be looking at slightly different moving average, but same general area. So I love the first test of Anchored VWAP after a significant earnings gap. And Fastly had really good catalysts. It's involved in AI. You don't need to know too much that it was a game-changing report.
Yeah, that was a beauty.
Yeah, exactly. I want to come back a little bit to volume weighted average price because it's significant as well, because institutions use it for execution, for judging their execution as well. That's kind of how it initially, that's why it's kind of integrated into all these algorithms that institutions use. Is that right? Or is there a little bit more nuance there for why you find it to be so significant?
Well, that's how it came about was, how does an institution know whether their broker did a good job buying 500,000 shares of Fastly today? The range is, so this has an ATR of 9.78%. How do you know if you got a fair fill when you've got a 10% range that day? Well, you can look at it and say today's range was, did they report today?
No, I think just DOCN reported.
Oh, they report tomorrow, I see. Okay, so their low was 29 to a high of, 32 and change, 32.77. So how do I know if I got a fair fill in there? Well, you stick the volume weighted average price on that. Today's volume weighted average price was right at about 31.60. So, if you said, hey, I want to buy 500,000 shares of this stock, and your broker, you can tell your broker, I want guaranteed VWAP. And they'll say, okay, we usually charge, 1 penny per share. But because this is a wild stock, we're going to charge 5 pennies per share for that. But we'll guarantee you VWAP. If we fill it at a higher price, we eat the loss. If we get it at a lower price, then we're going to, make some money on it. And that's why they'll try to do that, drive it down. So now they're vested with their customers' interests. They're saying, okay, we'll beat the VWAP, or we'll guarantee you VWAP. Now we're going to go in there, we're going to get really scrappy, because if we can beat the VWAP by 20 cents on 500,000 shares, we're making some real money here for our profit desk, for the trading desk. So if instead you didn't give that guaranteed order and you said, hey, it closed at 32.38 and that's your price. You're like, oh, okay. Well, no, you ripped me off. I mean, I paid 80 cents more than the average participant. Like, what have you been doing all day? So it's known as the price a naive trader can expect to get. Like, no matter what time of day you went in there, that's adjusted for every single share, the average price. So as the day goes on, there are, buyers that say, hey, we need to buy as much as we can at VWAP. We have these VWAP orders. The stock's been above that all day. Maybe we'll try to get cute and push it below the VWAP a little bit, but we can't get too risky because we can't short 50,000 shares and this thing rips on us. Maybe we can drive it down a few pennies, but if it's a super strong stock, they're just better off with their bid in there, buying as much as they can. That's why you see it so strong there. So as you said with Fastly, we have 3 or 4 days after that earnings report. It runs and runs, and then it undergoes some regular profit taking. So that profit taking occurs on lighter volume as well, which is the pattern we want to see, up on big volume, lighter volume on a pullback to the key level, and it touches that VWAP and closes on it one day, gaps lower a little bit the next day, and then recovers, and then that's the low of that pullback. Well, what happened in there was they drove it down to that VWAP. They probably even, it wouldn't surprise me if they said, let's short 50,000 shares in the pre-market. Let's drop this stock down and really scare some people. And like I said, we'll short 50,000. We'll get long 250. So we maybe make 5 cents on our short, but we're now 200,000 ahead on this order because we're going to keep buying this stock for the next 6 weeks. And that's why it wasn't until, 6 weeks later that the volume weighted average price was tested again in there. And same thing, we saw a little bit of movement around there. The trend's a little bit more mature, so we can't expect it to hold as perfectly. There's different groups now in this stock. So it's not just the pure VWAP from the earnings. So you've got, different VWAP participants as well. The VWAP short sellers who are saying, hey, it just dropped from 35 to 22. Let's put in a VWAP order to cover.
Right. And in this example that we've talked about anchoring the VWAP from the earnings report, that significant event. I want to bring it back a little bit. So if there's folks who are completely new to the concept, they can follow along with us. So what is anchored volume weighted average price? And we've talked about volume weighted average price. We've just mentioned an application of anchoring it to a key event, the earnings report. You mentioned the year-to-date volume weighted average price as well. Could you define for us simply what is anchored VWAP? What is that to you? How would you define it? How would you explain it to somebody who's maybe never heard the concept before?
The anchored VWAP is anything other than the start of the new day. So the new day. So if you're a day trader and the stock has a real volatile run, it runs 10% in the morning, hits a high, pulls back 3%, well, put an anchor on that high, and you'll see once it recovers back above that, it might bump up against it a couple times and breaks back above that. Well, that's an anchored from the high that occurred 2 hours ago. More traditionally, for instance, for the institutions who want to build a big position and are comfortable buying a long-term position in a stock, they're going to say, we want to buy this stock for the next 10 weeks. We love their earnings. We think this stock's on fire. It's in the right group. Everything's going, but we don't want to just chase this thing. But if it pulls back to their VWAP, we want to be a net buyer in there. So buy as much as you can. So it measures the average price adjusted for volume from any point that you choose, whether intraday or the beginning of the week or the 2-day VWAP, the month to date, the year to date. So let's hit some of the most important ones since we're on this. So we've already discussed earnings, which is just fantastic because it combines the fundamentals along with the technicals and who's in control and where do they gain control, where do they lose control. So that is an event anchor. A Federal Reserve announcement is an event anchor. That'll often be good for 3 to 8 to 10 days that you'll see, like the S&P, find adjustment around that, in particular if it's in a move that wasn't expected from the Fed. These ones where they just don't do anything, it doesn't matter. But if you get a big catalyst,
big volatility, that kind of that spike of that, yep.
So that's an event. You've got time-based anchors, so the daily VWAP, week to date, month to date, year to date, and then you've got price anchors, so highs and lows. What is this year the low, the April low that we saw? That anchor hasn't really been tested, but it will. It's not important right now when you look at a chart of the SPY, because that anchor is.
Do you want to bring that up actually, Brian, so people can follow along? Yeah.
So on this chart, on the left, I've got the daily chart of the SPY. And on the right, let me just clean some of this stuff up. On the right, I've got the 30-minute time frame. So here on the 30-minute time frame, you can see this is our low that we saw this year, right? And what did we see? Well, initially, we had it tested right here, and then again right here, and right here. Then the market really took off from there. So that, that anchor is down at 686. There's no value in that to us right now, but it doesn't mean there won't be in the future. So what we want to do is we want to say, okay, what about it really took off right here? That was a new momentum campaign right there. And then notice how that right there was where we saw it pull back perfectly to. I bought, and I'm still holding from some of that right there. When I bought right here at I think it was 681 or 682, I thought I was so late. I was kicking myself because I didn't buy the bounce from the 5-day moving average twice. But if you recall, this was the ceasefire. And that's when I was like, well, this thing could go either way tonight. If it gaps up, it can go without me, because it might be right back down to 622. And I wasn't willing to take that risk. And I didn't buy it actually I did buy it that day because it was a chase the gap or wait for VWAP for a day trade. I did not hold it. Hindsight, maybe I should have, but that's hindsight. I did hold this one. So now we've got this new momentum campaign. And what we'll do is we'll hand off again. So we'll hand it off and say the last time, so is that anchor relevant to me right here, right now? Maybe if we get a sharp pullback, I want to be aware of that. But even now, it's just not realistic. I don't think that we're going to pull back 25 points to that. So our next level of interest to anchor from was the last place that anchor was touched. So when we do that, notice what happened right here. That was where it was touched perfectly. And then we could anchor from there again. And this is where it started getting a little bit wobbly, because we were underneath that anchor. And you can see there, that's the 5-day moving average. But we were below those. That to me turned the light caution. It didn't turn it red because we were still consolidating in this range. And now we've had this new momentum campaign begin just after this, this right here. You could say that's kind of the beer. I guess you could say with that gap, that is an important event. And now we came down, we touched actually where I have my anchor, I don't know why it's not showing here, is right here. This is the month-to-date anchor. But we came down, we tested the breakout right here and the 5-day moving average. So right now, when I look at managing risk, I say this is the most recent relevant higher low. If it breaks that, I'm going to sell at least a portion of what I bought over here. And I was thinking about, I almost sold it in here when it made that lower low, but it didn't violate my rule for that at that point. So these are, key anchor points, month to date, from the beginning of the, and I know you wanted to mention handoffs, and that's exactly what we're talking about here, is these handoff levels where it touches each one of these, and then from the beginning of a new momentum campaign. Prior to that, I had an anchor on the year-to-date high, and that year-to-date high was resistance a couple times during this downtrend, but we had that lower highs and lower lows. And it was that gap up where the buyers were back in control, not only from there, but I don't know what happened to my year-to-date anchor, but the year-to-date anchor is right in there. And I'll just make that blue so we can see the differentiation. Yeah, it's probably not exactly on the year-to-date, but it gets the point.
Maybe someone who's colorblind has no idea what we're talking about, but most of us will. Yeah.
So anyways, that's why I bought in here. And like I said, I thought I was late on this purchase. Yeah. I was like, man, it just came from 630 to 680. But I've been sitting here, day trading because I don't trust this thing. I got to own some stuff. And that covers, I think, the highs and lows. And, it got a little bit wobbly this week, but, did it right here because the month to date was the year to date high at that point. and we were below that, but it didn't do any structural damage. So I was looking at saying, okay, it's just a pullback. Let's see how it behaves at the 5-day moving average. If it gets trapped, if the market instead had done this and gotten trapped under it, and the 5-day average would have looked like this, then we'd have a different scenario to work with. But it survived. So now our definition of trend says this is the most recent relevant high or low. Raise your stop up under there.
And do you typically raise your stop on that whole position? I guess once we're getting more extended, maybe it's like past your certain time frame, are you following pretty closely on the most relevant intraday high or low, or are you doing that on only like 2/3 or a third of your?
Great question. One of the stocks that we'll talk about is actually SanDisk from 2 runs ago, where I did it really well. And I'll show you how I did that.
Sure. And going back to the year to date and maybe that Anchored VWAP that you had from highs there, talk to me about what's going on psychologically when you anchor it to highs like that, and basically buyers are able to push us above that level, because I think this is another key and really relevant Anchored VWAP for traders, breakout traders who are trading maybe early up the right hand side. There's often resistance at that Anchored VWAP that comes down from highs. There's a consolidation, and then the early range breakout up the right hand side is often a break through that Anchored VWAP. So yeah, I'd love for you to kind of break down what's going on behind the scenes there psychologically and from your perspective.
So we're looking at this. Red is the anchor from the high. Orange is the year to date on the daily time frame, and then that blue is the 50-day moving average. I fully expected in here, I fully expected that we were going to at least time correct in here. I thought we were going to maybe pull back to the 20 and then get going. So for me, this was a really uncomfortable buy right here. But I just felt like I have to. I know where my risk is. My risk was under here. That was my high or low. I said, I got to, we get paid to take risk. Now's the time to do that. And fortunately, it worked. It didn't, cave in like I kind of thought it would. In the moment of the heat, in the heat of the moment, I was thinking, there's no way this works, buying this extended. It never works for me like this. But it did in this case. So when we get back above that year-to-date anchor, the orange line and the red line, what it says is, the bias for the year, basically, at this point, we were down, I don't know, what were we down, 9%, 10% or something for the SPY in that area? So the psychology was terrible. We were below declining 20, below declining 50. We even broke the 200-day moving average. And then we came down to pretty close to the anchor, which I have on all my charts, is off the tariff lows. And it wasn't perfect support, but it was a level of interest. So people say, well, why do you have it on there? It didn't work. Because that's the neighborhood I want to start taking a look at. And I want to look for evidence. I didn't see the evidence there. I mean, I think I day traded over in here, and obviously you could say, well, don't you wish you held that? Sure.
But you don't know what's going to happen. That's not a strategy.
That's not a trading brain. That's a hindsight brain. So at this point, the average participant who's had this bearish scenario and who's been leaning short against the market because they think, hey, the whole world's going to blow up. Oil's at 80, it's at 90, it's at 100, it's at 105, it's at 110. Interest rates are soaring. We've got, people will say a madman in the White House. I'm not making it political. There's no way this market can go up. Only price pays. That's the point, is that you've got to put all that stuff to the side. And just recently, we've seen the same thing. Look at the volume. The volume's been declining. Who cares? So what? You don't get paid on volume. You get paid on price. Someone last Friday said, are you concerned about the gravestone doji? And I said, no, it's one bar. We're still above a rising 5-day moving average. And then I laid out the scenario. Let's see what happens if we pull back and test the 5 in this prior resistance. If it breaks below that, in hindsight, we might say, oh, it's because of that gravestone doji. But now that's been swallowed up by, new highs. So we have to look at it and say, what's information? So I have a Discord, and one of the channels in there is called Interesting But Not Helpful. As you can imagine, Richard, I'm a little bit of a hard ass. I'm like, okay, so what? How does that help us make money? what are we doing here? We're trying to make money. I call them back of the baseball card statistics. 5 out of the last 8 times when we had a full moon and we were touched the 20-day moving average, we had 18% return 6 months out. That's not a trading strategy. That doesn't mean anything. It means, okay, it's like seasonality. Sell in May and go away. It's been awful. Santa Claus rally, last 4 years has been a complete dud, right? Those are times of interest. Okay, I'm interested. Typically rallies in this area, I'll be extra alert. But I'm not just going to buy because of some stupid little Santa Claus rally thing has worked 8 out of the 13 times, whatever the numbers are. I don't know. It just says, pay attention a little bit, be a little bit more on your game.
And I want to zoom in a little bit on the confluence that you pointed out of that level and the 5-day moving average on the intraday chart. Just shortly, this past pullback, this most recent
Yeah. So this little consolidation.
Yeah, just talk to me a little bit more about levels of interest and why you specifically say of interest and not of must obey to the cent and stuff like that. Break that down for me. That would be great.
People always say, well, the market has resistance. When you're down here, they'll say the market has resistance at this point right here. They'll say, well, that's resistance at whatever, there's resistance at 695 when you're at 680. And I'll say, well, no, you don't know that. We only know support and resistance in anything in hindsight. We don't know whether that gravestone doji meant anything. If it failed from there, you'd say, okay, well, that's why. We didn't know that Fastly was going to find buyers at the year-to-date, the earnings anchor, and the 50-day moving average. But when more people come to the same conclusion in that same area, it kind of increased the odds because one guy might be thinking, hey, the 50-day moving average, I'm going to buy there. Another guy might say, it's the earnings anchor, I'm going to buy there. Another gal says, I'm going to buy at the year-to-date anchor. She got it right. They all got it right, because it moved well from there. But there are levels of interest, and we want to say, why are they levels of interest? Well, this was a level of interest on it at 695 because we had previously been rejected there 1, 2, 3, maybe 4 times. So there's price memory in there. What that says is, and that's what the VWAP is, price memory from the beginning of the year. Where's the memory? Where's the average participant anchored? Where's their bias? So this becomes, the more volume that traded there, the more likely it is there's going to be people saying, well, I'm at break even. That really sucked being down 10%. I'm going to break even. Thank God my wife didn't ask me how the account was back then. I dodged her. We're back to, we're up 1%. I'm going to say we're successful in the market. And other people might say, hey, I'm going to short there because that's resistance. But it's a level of interest. So when we get to that 695 level, we can zoom in over here a little bit and say, well, what happens at that 695 level? We can look at it and put a horizontal line on that and say, was there any evidence at all that there was resistance there? If you call that evidence right there, it's wrong because what we're looking at is a trend. We saw a higher high, we saw a little pullback, and then we saw a higher high. Well, guess what? That became your important higher low. Buying here with a stop under there. That's a valid entry in an extended market. And then it makes a higher high and a higher high and a higher high in these higher lows. Raise your stop up under these higher lows and maybe get stopped out of that swing trade right here, right? Because not even right there, most likely right here, because we have this high, then we have a lower high, then we have the lower low. But I would also tell you, we're right on the rising 5-day moving average, so give it a chance. It's still innocent until proven guilty. Still give it a chance because the 5-day moving average is rising. Now the 5-day moving average is flattened out. If the sellers are going to gain control, they're going to gain control right here because this was 5 days ago, and that would have started to roll the 5-day moving average over, and that would be evidence. A lower low here would say, okay, that level of interest up in here broke down. Now Let's see how it behaves on a pullback to the 10-day, to the 20-day, to the Fibonacci, to the VWAP off of that breakout. And those are all these technical tools is levels of interest. How does it behave there? It's not a magic formula. Sometimes they seem magic. All I do is buy the 21, the touch of the 21 EMA or the 20 SMA or the 50 or whatever, the VWAP off of earnings, and it works every time. No, it doesn't. Because if you get that mentality and you don't do the most important thing, which is manage risk, it's going to work 8 times in a row, and you're going to just think you've cracked the code to the market. Then you get one time where it does, something like, a disaster like Poet. And they buy up here at 15, and the next 3 days later, it's down 50%. Or they decide, yeah, car is definitely going to 1,000. I can buy it at 850. And they, I've been scalping it all the way up, and here, this is great. Now it's clearly going to 1,000. Where's your stop? I don't know. What do you mean? And then you're down here, and 8 out of 10 times is great. But 9 out of 10 times is great. But if you don't manage the risk, you're going to get blown up. And what it does psychologically, it's not even just the money. What it does psychologically, I mean, I feel like if I did something 9 times in a row, I'd feel pretty smart. But then if I lost all that money on one time, I just would hate myself for that.
Yeah. And could you bring up the SPY? I've got one thing that you said that I want to double click on. You mentioned the volume and how we've been rising on lower volume. And I know you've said this before, the biggest volume often happens at turning points and not necessarily during the trends. So I love if you could kind of break down how you interpret volume. Like you've said, price is the most important thing. We only get paid on price. But how do you incorporate volume into your analysis? How much do you weight that versus what's going on in the chart itself? How do you use it as you kind of look through multiple time frames?
Yeah, I mean, if you look at the high volume bars, I'm a SPY right in here. We can draw a horizontal line on these, or vertical line rather. That was a turning point. That was a turning point. That was pretty close to that was the turning point of that pullback. And that was pretty much your turning point there as well. So, and we saw what happened. We saw the volume expanding on the way down. Fear was just churn, but we saw the volume expanding, and then we had maximum fear down here. That's when your VIX starts soaring. Your the greed and fear index goes down to 12, and those aren't buy signals because we had this big volume bar right here that looked like, well, maybe that was the turning point. And this was the retest on the higher volume. So again, it's not a magic, hey, that's the biggest volume, because we might have been down 10 points this day on even bigger volume. Right. So it's just a reason to say, well, this is the biggest volume in 6 months. That's a reason to think we're maybe in the neighborhood of getting enough fear where we're going to turn. And just the same, you look at this and say, man, the volume keeps diminishing. And you could say, I'm going to short it because this is a bullshit rally. It's up on no volume. And I hear people saying that. And I hear the old me saying that 20 years ago, thinking, that's up too much. This is stupid. We've got, oil at this. We've got interest rates doing that. We've got the war going on. So listen to price, defer to price action. These are all just tools that tell us these are things to be interested in. Right. And if they're flashing, then it means either get ready to buy in the case of, okay, we're getting washed out. Or if it's flashing, then oil is still maintaining its bid. We're up on leg volume. Breadth is narrowing. That's all good information to say, okay, if price starts breaking down, it could get ugly. Therefore, I need to have my risk and move to the sidelines. It's not good information to say, okay, breadth is narrowing. I've got to get out. Those are completely different things. And that's how people misuse technical analysis a lot, is to say there is support at this moving average. Let's see how it behaves.
No, absolutely.
Level of interest. Yeah. So I think I did beat that answer to death, sir.
That's good. No, that's perfect. It's worth hammering home. Brian, I want to jump to the trade case studies that you prepared. And I think we'll dive into some more concepts as you go through those. So let's dive in. Where would you like to start?
Okay, so you asked me for 2 great trades, 2 normal trades, 2 losing trades. Let's start out with the losers, um, and then with the big winners, and then kinda normal, more so US Foods or actually, no, Caesars, I'm sorry, I wanted to look at Caesars. I put Caesars on X as well. So Caesars over in here looked like it was breaking out. And that was on 416 where I purchased this one. And first of all, Caesars is, its ATR is 3.3%. It's not a tech stock. It's not, and I was looking at the market thinking, well, the market gets extended, all the leaders are extended. Let's go for something a little bit more conservative. So I bought it on this day on this push higher right here. And then I sold a third of it. So I bought it at 27.58. I sold a third at $28 per share. That was my 2-minute exit. It hit daily R2 that day, and it went a little bit higher. Then it broke a 2-minute low. So that first third I locked in for 42 cents. And my initial stop was at 26.22. So on the 16th, right over in here. So my initial stop was 26.22, which was below this low. So I bought it at, what did I say, 27.58, right over in here, I think on this day. It was probably this day right here, actually, after that gap up. And then I sold my first third at 28 on this day with that 2-minute exit. And it came crashing down all the way, and I raised my stop to there and got stopped out at, 27.39. I must have gotten stopped out on, I don't remember which day, but I got stopped out. Maybe it was this day. I said under here, 27.39. So I made 42 cents on 1/3 and lost 19 cents on 2/3. So it's basically a break even. But the reason I chose this as a losing trade is to kind of show, a lot of times people say, well, don't you feel like you give that first third away sometimes? Because, ideally what we want to do is we just want to see the stock go up and up and up and up. And if you sell a third of it right over here, don't you feel like a jackass? No, I don't, because when I feel my timing is good and I have an A plus trade, I'm going to go in with my maximum position size. And I go in with my maximum position size right from the start because my strength is my entries. Because I'm looking at the weekly chart, the daily, the 65, the 30, the 5-minute, and the 2-minute chart. So I'm getting as precise as I can. So I want to take a little bit of risk off because I've gone maximum size. And if I cut it down, now I'm at normal size. So I can feel comfortable holding that 2/3, which is my real size. And if it comes down and stops me out, well, I lost a little bit, but it was basically a break even. And only because I sold that first third. Otherwise, it would have been not a full risk unit because I raised the stop from 26.22. And I guess I'd still be in it if I hadn't raised the stop, but I'm glad I'm not because this is just a stupid stock the way it yeah, a mess is better than stupid stock. But so that was one. Now I think I have one that was a real loser.
Before you go to that, for obviously you're mentioning thirds of the position that you had invested in the stock. How much of your portfolio do you put into typically, one trade that you put on? And does it depend on the risk you're taking? You can size it a little bit more if your stop on that is tighter because the swing low is closer to your entry. Yeah, walk me through kind of how you size these positions.
So I'm a fan of the R multiple. An R multiple just says, you have a $100,000 account. The most you're going to risk on a trade is $1,000. Now, for people at home, this doesn't mean that means you're going to buy $1,000 worth of stock. That's not your risk. Your theoretical risk of $1,000. So if you buy the stock at 10 and you buy 1,000 shares and your stop is $1 away, that's your risk unit. You're letting it, $8.99 is your stop. If it breaks below that, you're out. So you buy 1,000 shares. But if your stop is at $9.75, your risk is 25 cents per share. Now you can buy 4,000 shares of that stock and have the same amount of risk. So you're leveraging based on how tight that stop is. Then you've got to say, well, am I just creating a tight stop because I want more shares and I'm more likely to get stopped out? Or is that actually a real higher low that if it breaks, so I'm always looking at, makes that first higher high. So I look to the prior higher low. If it breaks below that higher low, then I'm out because my emerging definition of trend no longer exists. I had a higher high, but I broke the higher low, so trend is over, got to get out. If it's truly 25 cents away, buy 4,000 shares. Maybe I'll buy 5,000 shares and sell that first 1,000 shares up 25 cents just because I like to trade and make $250 and, hold the rest and use some other rules for getting out. But what I'll often do at the same time is say, okay, if it breaks below 975, 975 is the higher low. So I'll set my stop at 973, give it 2 pennies below, maybe 3 pennies below, usually 2. But that seems tight and the market's a little squirrely right now. So if the market conditions say, yeah, don't do that. But there's another low at $9.43. Then I might put half my stop at 973 and half of it 941. Say, okay, if it just comes down and wicks me out, then I'm, fine. I've still got half my position. And maybe if it recovers, I'll think from a failed move comes a fast move, I'll get back in, pay a little bit higher price even. And that reminds me of a rule that I want to kind of remind people of here too, is when I say a stop, I never set my stop before the market opens. That's not a real thing for me. So if my stop is 973 and the stock opens at 968, if I have my stop in, well, I'm out at 968. And what I'll do instead is I'll give it 5 minutes. So I'll give the first 5 minutes of the day because I know that there's people playing games in here who like to open the stock lower so they can buy more stock. So if the first 5 minutes it drops down to 958 and then it starts to recover, as soon as minute 6 begins, I put my stop at 956. If it breaks back below that, well, then it's not recovering today. And then if it continues to rally, then hopefully I can salvage the trade. And that's happened so many times where I've had stocks where I should have been stopped out technically if you consider, but Brian, you said the stop was there. Yeah, but I said don't say it till 5 minutes after. So that keeps me in a lot of winning trades.
Mm-hmm. Excellent. Yeah. So you covered risk multiples, how you manage risk, and how much of your account, what percentage do you kind of have as your R, what you're willing to risk on any given trade?
My percentage of R is tiny. I just am not a big risk taker. It's something I work on all the time is that I have to be greedier. I have to be more accepting of bigger losses. So I don't really look at it in terms of that. It's more, okay, here's my maximum risk. And I'm trying to, and I'll trade around it too. So if it runs 15 cents and it feels like, and it breaks the VWAP, and I've got 10,000 shares of the stock, and I haven't sold any yet, I might sell 2,500 as it breaks VWAP and take 13 cents, just reducing risk. Because if it fails completely, if it comes back to break even and the market's rolling over and I have 7,500 shares left, I might sell 5,000 of them and I'll have 2,500 left. And then if it recovers, it gets back above that VWAP, I might buy the 5 back, but not the other 2,500. So now I'm back up to 7,500 shares. So I'll get pretty active in there trying to really...
With that dimmer switch turning.
Yeah. And sometimes it's like, what am I doing all this work for? But a lot of times it really is, it's more about the mental clarity of, okay, I was just up 15 cents on these 10,000 shares. Now I'm down 22 cents. And it hasn't violated my stop, but I feel so much better if it goes down 22 cents and I'm only holding 2,500 shares and then it curls back up and maybe even buy a little bit higher. I don't care. But I didn't have to take that drawdown in there. And it's not that it's $2,500 as my R unit. It's more about just kind of playing around in there until I feel like, okay, I've got it. I've got it by the tail. And now I'm in a position of strength.
Gotcha. Perfect. Yeah. Sorry to interrupt you, but I thought it was good to talk about position sizing, I think. So yeah, jump to your second trade here.
Okay. All right. So USFD, this is one I also put on X. And I bought this on the 27th, USFD. Oh, yeah. So I bought it after the open right in here. Oops, right in here. And I paid, so no, I didn't. I bought it right over here. Sorry. 93.50 is what I paid. So I bought this breakout because it wasn't very extended. And I had my higher low right here. And I got stopped out that same exact day for a full risk unit. And it's since, and you look at, I mean, I look at the stock, this was an earnings report, very similar to, well, no, it's not similar to that. Never mind. So it was, here's the earnings, the anchor from the earnings, and it just kept hammering away at it. The 50-day moving average was starting to flatten out. The 20 was coming back up. It held the year-to-date anchor on, 5 different occasions. So it was, here's, an anchored VWAP pinch. And let me just say a word about anchored VWAP pinch. I kind of wish I never wrote about them because everyone is talking about VWAP pinches. And technically this is a pinch, but it's a terrible pinch because it's so wide. What I want to see in a pinch is something like this. I shouldn't have drawn that last one. Is something that looks like this, that it really compresses. So like what Minervini calls a volatility contraction. Thank you. Contraction pattern. So what I want to see is I want to see the volatility contract. I want to see it, get really tight, like a ascending triangle where it gets really tight at the end. That's a pinch. Buying a break of the pinch up here, no thanks. It just ran from 88 to 95. It just ran 7 points. It ran 8%. I don't want to be a buyer of that breakout on that first move above it. Now, and here I've just given up on the stock because it just keeps having these, it breaks out here, it breaks out here, it gets hit, it gets hit. The next one probably goes and it goes without me because I've been burnt twice in this one actually. So that's, the question of, am I being stubborn or am I being persistent? Well, the personality of the stock, and it's only a 2.5% ATR, but you can't base volatility just on that number. You have to look inside and say, what's the personality of this stock? And that's something a lot of people don't do. They say, oh, I don't use intraday charts. Well, understand the personality of the chart. Is it like crazy, on the open? Is this a stock that says, and this one's not a horrible example, but if you just look at the, the 930 bar and say, wait a minute, I'm not going to buy this thing in the first 15 minutes of the day. Look at all these false movements, all this false movement in here. Let's understand the personality of stock a little. So there's that was a full losing trade because I bought the strength, made that higher high here. I wanted to buy before this higher high because I didn't want to buy, and that's this one. I didn't want to buy it extended. I didn't want to wait for that. So I figured I was getting the head start. The 5-day moving average was rising. This was the most recent relevant higher low. I thought it was impossible it was going to get hit because that wick I thought really, it hit that anchor off of, that was the, what was that anchor? That was the anchor for the market low, which obviously the stock isn't respecting at all. It's not respecting anything. It's on the ban list. Okay, so that's 2 losers, 2 good ones. And this one wasn't my normal trade because this was more about, so let me get to the, I'm actually going to get to the weekly chart. Because this is Target Therapeutics, and I found it and started buying it right in here. And I read a little bit about it because I was like, we've got their 20-day, 20-week, above the 31-week, above the 42-week moving average. It's just breaking out. And I looked at it and said, I love this chart, but it's Target Therapeutics. Therapeutics means biotech. Biotech means you're going to have moves like this, on a regular basis. And figure out something about this company. What is it, what they do? Because I want to buy I want to buy a real position. So I bought a real position. I bought a real position. And this is my best trade actually of 2024. And it looks like a mess on the weekly chart, but I did a great job of, ran up. I sold a bunch of it, held some even through this, loaded back up right in here, even bigger than this time. Kind of got chopped at, sold some, got chopped up in here a little bit, loaded back up even bigger. So this was a big size, this was bigger, and this was even bigger. And then I caught this rally just beautifully and sold like as it was breaking, just starting to break down. So that was a huge trade for me. Um, and I need to do more of those because even though I didn't hold any of the original shares the entire time, it was that campaign more. I consider it that, that trade or that campaign.
Trading around the
Yeah.
position. Yeah.
Yeah. So that was a beautiful one for me. And then I mentioned um, the first run in SanDisk. And what I consider the first run in SanDisk is right here. And so when we look at the daily chart, what we're looking at is right here, this move. So September of 25, and this is the second move. And this move is the third, which actually, as a little aside, I do have a small piece that I'm holding from right here. It broke the 50, came down to the year to date, and it started bouncing. I bought some there, and I sold most of it, and I sold the majority of it up in here, but I'm holding some just to tell myself I can hold something crazy. I'll probably sell it. I don't know where I'll sell it, but I'll probably write it down a lot because I'm trying to prove something to myself. Anyway, so this was move one of SanDisk. And when I was looking there, this is something I'm trying to do a lot more of, which is when you see a real clear, strong breakout, right? And we can look at it right in here. And, let's say we can't see what happened. So, okay, so it broke out right here. And there it goes, of course. So it broke out on big volume, the biggest volume it's seen in a long time, on a gap. And that was, I think I purchased it, right around in here. I didn't buy it, on the gap, but it pulled back, got back above it. I bought it there, set my stop below here. And I said, what I'm going to do is I'm going to hold this one. I held a third of it, and as it made the lower low below the rising 5-day moving average, I sold my first third right there. And then my plan was I'm going to sell if it makes a lower low below the 10-day moving average. It didn't make a lower low, so this was the lower low that I was using at the 10-day moving average. I said if it goes below there, I'll sell that third, and if it makes a lower low below the 20, which at that point was right here, then I'll get out of the balance. So instead, it kept rising up, and I sold right here the second third because that right there was the lower low below the 10-day moving average. And then if I can move that back over so we can see the rest of the...
And just in case, if people can't see clearly, the 5-day moving average is the blue one, the 10-day moving average is the green, and the 20-day is the orange moving average.
Correct. And then I never expected this to happen. I sold that final third of SanDisk. I sold it below this low. I said, good enough. This thing's getting the shit kicked out of it. I just held this stock for 200 points. I'm getting out. I don't care what my rule was going in. It's time to break my discipline. So that was really a great move in there. And I had a lot of shorter term trades in between, but what I did in this case was when I was trading the stock, I was actually trading this at Fidelity because in my Fidelity account, I tend to hold things longer because I don't have my level 2s right there and I have to pull it up and type in the order. So in that account, they have the option to say, do you want to sell specific shares? So I always just, buy, sell, it doesn't matter, first in, first out, whatever they do. So what I always do is when I'm trading it, let's say I buy it here and sell it there. What I'll do is I'll say, sell the most recent. So I still know what my cost basis is down here. So I can look at my account and go, oh, you're so smart. So anyways, and then, that was SanDisk. So that was a more pure trade in the trade that I strive to, that I don't hit nearly often enough. I didn't do it on the second run in SanDisk. And I'm kind of doing it on this, but it's such tiny shares that I'm left with right now that in my mind, it doesn't count.
Yeah. And Let me ask you this. I've got two questions, but first, how did SNDK get on your radar? How did it get on your radar to make that first trade?
I, you know, it wasn't really, I think that, so the earnings were right here. So it wasn't an earnings gap. I don't remember what the news was back then, Richard, but I think there was news. And, everyone was talking about it. And you can see that was, the biggest volume ever. It IPO'd, and usually the IPO volume is big, but that was the biggest volume ever to that point. Or maybe this was a little bit bigger, but sustained volume here for a couple days. I honestly don't remember. I think it might have been just, a lot of times what I'll do at the end of the day is I'll go look at what were the top movers and see if, there's some big breakout I'm missing. CYTK was one, I think. No, CTYK. I don't know. There was one today that I added to my list because it was a big breakout. I've never heard of the stock. So I don't remember how I heard of it.
Yep. What I guess what drew you to it? Was it that it was a recent IPO, that it was kind of set up on multiple time frames, like stage one transitioning into stage two? What kind of, I guess, made it a priority focusless stock for you?
I remember it had been a hot IPO, and I was keeping track of it with the anchor from the IPO, which in this case, it was kind of back and forth above and below, as you can see. So that's that purple line. It resisted there. It kind of supported in there. It definitely supported there. Then we had, at this point, over here, we had the 20 and the 50 crisscrossing each other. Or I'm sorry, the 5 and 10. I'm so used to looking at daily charts. And then we had the 5 above the 10, above the 20. And when you look at the daily time frame over there, we had the 20 above the 50, and we didn't have a 200-day moving average yet. But it reminded me of Tesla in original breakout that way back.
The 2013 one?
No. Probably 2013. I remember that because, exactly right here. It reminded me of Tesla right in here because I wrote an article about it, and I was loaded to the gills in that and got so much of this move. It felt like such a genius. But it was a nice trade.
Yep. Awesome. And then my second question was, you showed that trade on the 130 time frame. This might be a loaded question to ask someone who wrote a book on trading on multiple time frames, but do you have a favorite time frame for your style that you manage a trade more on, or it's on all time frames?
My favorite answer actually came with an interview with you before, and it just came on the spur of the moment. I was like, I gotta remember that. That was good. So I said, well, Richard, Pablo Picasso, his favorite color might have been blue, but maybe he emphasized that in his paintings. I'm just making this up. I think I said Van Gogh back then, but Kina says it's Van Gogh because she's Danish. But anyways, it's the whole palette. How do they weave together? I need to, so anytime I present charts, I'm showing people at least 2 time frames. So, and here, look at SanDisk riding this 5-day moving average after touching the year-to-date anchor right there. It's just been beautiful above this 5-day moving average. So how do they blend together? And when do we see these consolidations? And how can I say, okay, that's a fake break higher. That was a fake break higher. Now this looks like the real one with a stop under here. Oh shit, do I get stopped out because it made that lower low? No, it touched the 5-day moving average. And it's stressful in there. These are big numbers. They're moving 40, 50, 75 points a day. It's 150 points today. These are insane moves. Even on small share size, it's, real money.
Yep. Excellent. No, that's a great answer. Let's jump to, I guess, your next trade, your next case study.
Okay, so these were what were kind of more normal types of trades.
So these are kind of singles and doubles.
Yeah, run-of-the-mill swing trades. So Albemarle, they do, lithium and rare earths and some more established minerals and that sort of thing. But I bought Albemarle at 188. So I think that was on this day, chase the gap or wait for VWAP. I sold a third that first day up $6.90. So that was, what would that be? 191-ish or whatever that might be. So up in here, I sold that first third. Then the second third, I sold up $18.40 on this day. I think I used a 2-minute exit somewhere in there. No, I'm sorry. I didn't sell it on that day. I sold it under here, right here. And I think that was up $18.40. And then I kept my final third right under here, which I thought there's no way that's going to get hit, right? How's it going to give it? I mean, this thing went from 188 to 215. And then, so, I sold a third here, and I got stopped out of the final third there. By the way, it looks like it's setting up again. Like, here's the rising 5-day moving average again, finally. And it looks like maybe it's going to get going. Although all of these rare earth plays have been kind of not so good. And that's maybe more lithium or some more than rare earth. But so that was a decent trade. I mean, for the amount that it was up, on average, I made $11.20, 6%. And that's a nice, few days. But I tell you what, this day sucked when it gapped down and just kept going. I was like, well, there's no way they're going to get my stop. It's way down there. It closed at 215 and I got my stop at 198. But, honor your stops because, I could have ridden it all the way down to a loser in here. And it's, lower highs and lower lows below declining 5.
Perfect. And are you typically shooting more for singles and doubles, or are you trying to expand a little bit more into the triples and home runs when you can? Obviously, when the market is trending, it's going to reward that, versus a choppier market, it's going to reward more turnover, more just taking the singles and doubles what you got it. But in general, are you trying to extend your time frame a little bit in general?
My risk management tends to be so tight that they end up being singles, doubles, and some triples. And the home runs, I have to really work hard and be uncomfortable holding things and reminding myself what I'm trying to do with these final shares of SanDisk, and just amazed, that they go up $150 in one day. Because again, even on small shares, it matters, right? So that's something I work on. But at the same time, the number of trades, I think that there's a couple things that keep me in that arena, is that I do have tight stops. I don't have much tolerance. So I get stopped out on more. I take more trades and I get stopped out on more trades. And sometimes I fail to switch gears and say, no, wait a minute. Don't forget, this was that big earnings and it's gapping out on this. And there's guys like Jim Ropel in there just buying the shit out of it, and other people doing this. And there's probably VWAP programs in there for the next 10 weeks, 12 weeks. Don't give this stock away. So I have to, and that's, so I realize I have a little bit of different personalities. So my absolute most active account is the IRA that I have at Ameritrade. Because if I'm doing all those transactions, I don't want to keep records on it. And it's profitable, so it's tax sheltered, but I tend to trade that the most aggressively. And that's, of course, where my level 2s are. So I can just, without thinking sometimes, I just like, why did I just press that button? Why did I just sell that? That was dumb. Whereas I've got to go to fidelity.com and I make sure I keep it closed during the day just to slow myself down. I say, okay, you got to log in. It takes a minute to do that. Yeah. And then you got to go select account, switch what share it is, and type in the number of shares, type in the price. It's not arrow up and arrow down. So I use that to kind of, prevent myself from being my own worst enemy.
Perfect. I've got two more concepts that you've mentioned that I'd like to come back to explore a little bit further. First, you've mentioned a few times, pivots, daily R2, R1. Not many people, well, actually, I'm sure many people are familiar with that, but I think there's a certain amount of people who watch this because it's maybe more of a intraday trader type concept. Would you be explaining kind of what those are, what they signify, and how you might use that, like you said, to sell a little bit or watch how it acts at that level and potentially sell, and how that kind of combines with everything we've talked about, Anchored VWAP, as well as, multi-timeframe.
Yeah. Okay. So here's a 5-minute chart of the Russell 2000, the IWM. And you look at this one today, and it gapped up. So today's VWAP is above the blue 2-day VWAP, the 3, the 4, and the 5-day VWAP. I already know it's above a rising 5-day moving average. So I look at this and say, okay, you've got a chance to trade this stock. Do you chase the gap or do you wait for VWAP? So you wait for it to get back above VWAP and make a higher bar above VWAP, stop below the low of the day. And it's a daily R1. So what you have are what's known as pivot, R1, R2, R3, S1, S2, S3. And you go to S20 if you wanted it, an R20. They don't get hit very often. But I saw a study once that said the average stock on a given day will trade between daily S2 and daily R2 87% of the time. Only 13% of the time does a stock travel outside of that range. So again, you look at it and say, if that's the odds and I buy the stock here, I don't really do price targets. So my target isn't daily R2, but I know that's a level of interest because only 17% of the time will make it beyond that zone. So I look at it and say, that's a level of interest. And if it gets up to there, what I'm going to do is I'm going to either use my 2-minute exit and say, okay, it's running into that. We have this level, so it hits it on this bar. The prior low was right here, the prior 2-minute low. So sell right as it undercuts it right here. And you'd be surprised how often daily R2 acts as the perfect high of the day. Or if you're short, the perfect low of the day. I was short this, it didn't hold it. Short swimmer, yes, I call it swimmer. But I saw today swimmer bounce off daily S2. Swarmer is what it's called, SWMR. Anyways, this one, perfect today off of S2, at least for a bounce, right? And to cover a third of it as it makes that 2-minute high right here and not experience the fear that you're going to give it all back because it goes from, $30.29 up to $32.29. Like, oh shit, I just gave away $2. Now it looks like it's doing that. And then you start to get emotional. So I can, like most people, even still be emotional. So that's the reason I have rules like this, is to say, okay, if they tell me 80% of the time it does this, well, when it gets up there, I want to have a rule about that. If I see that it hits the year-to-date anchor and the anchor from earnings 5 days ago, and it's looking like it's going to bounce, I don't want to buy it as it's bouncing, but I want to start looking at the shorter-term time frame and buy the strength with a stop under here. And every plan has to have, where's my stop? What's my exit? How do I manage the rest of it? So you sell a third there. Do you raise your stop on the balance under here because it couldn't even come down to the VWAP today and the buyers took back control? So if it breaks that, does that mean it's probably heading towards the 2-day volume weighted average price? And I don't want to give that up on a day trade.
Mm-hmm. Excellent. So, and just to add a little context, like these are based on statistics. That's why.
Oh, I'm sorry.
Yeah. And
so
yeah, go ahead.
It's the prior, there's a mathematic formula. I don't remember how it goes.
It's like a bell curve. If you can visualize that, most of the price action is going to be contained between, I don't think it's a perfect standard deviation, whatever the calculation is, but that's why most price action is between R1 and S1. It's like the meat of the bell curve. And then as you get to R1, R3 and R.
Yeah. Our S2 and R2 are the main meat, and then it tails out, and you get some R20s and
on earnings gaps and crazy stuff.
Stocks like CAR, and have crazy days. They're what's known as floor trader pivots. So if anyone's interested, you can Google that, find the formula, and most decent trading, all trading platforms have it these days.
For you, is it mostly on intraday timeframes, or do you look at on higher timeframes?
Yeah, great question. I used to look at on other timeframes more. Like I would have a spreadsheet where I would put in, I think it's the high, low, close, are the 3 numbers it uses. So when you use, today's VWAP, not VWAPs, pivots on the IWM are based on yesterday's action. If I want to use a weekly pivot or a monthly pivot, or some people use quarterly or even yearly pivots, You use the prior year's high-low close, the prior month's high-low close, the prior week's high-low close.
Excellent. Yeah, I just wanted to explore that a little bit further in case people are new to that. And then in that answer, you also combine the 5-day moving average, which I wanted to expand on a little bit more. So how do you use the 5-day moving average both for the market as well as individual names?
So the 5-day moving average, I've been using this for, I don't know, close to 20 years. And I don't, the way I came up with it was when I first started using intraday charts, I would have, the standard, I'd have the 20, 50, I expect, and I used to have the 100, 150, and 200-day moving average. And then I would switch to a 10-minute time frame. And it would leave those moving averages on there. You wouldn't set moving averages for different time frames. So I cleaned it up and started, I would have the 20, the 50, and the 200. And then I would move that over to my 10-minute time frame. And I noticed the 200 period moving average on the 10-minute time frame was really important. It would just contain trends a lot. So then I looked at it, I said, well, what's the significance? 2,000 minutes. There's no significance to that. So I started thinking about what is a day of trading, which is 9:30 to 4, which is 6.5 hours, which is 390 minutes. 390 minutes times 5 days is 1,950 minutes. So a 1,950 minute average is the true rolling 5 days. So on a 10-minute time frame, that's the 195 period. So here on the 15-minute time frame, 1,950 divided by 15 is 130. So this is a 130 period moving average. So the way I looked at it was, okay, well, that makes sense. It's a 5-day moving average, not a 2,000 minute. Those numbers, whether you use the 200 or this, it's not going to matter. It's kind of like I say, whether you use the 20 simple or the 21 EMA, it's not going to matter. You're in the right neighborhood, and it's not a buy signal. So I just look at it from an intermediate term perspective. If we have a rising 5-day moving average, we can spend a little bit of time below it, but are probably shakeouts. It's innocent till proven guilty. As it starts to consolidate in here and close below the 5-day moving average at that point, I start to think, okay, well, if it breaks down, then it's going to drag the 5-day moving average lower. So this vertical line here is where we were 5 days ago. So on this 15-minute chart, tomorrow the first 15-minute bar opens right here. This line will move forward 1 because it's telling me that moving average calculation is now calculating this bar and everything from here over. It stopped using the bar where that orange is right now. So that just shifts forward so I could start to anticipate. Even if the stock goes sideways tomorrow, the SPY, the 5-day moving average is going to do this because these prices are higher than these. We're averaging this data out tomorrow. For that 5-day moving average to be declining tomorrow, the S&P will have to come down below this level. That's not likely. And it will break this higher low first. So is that likely? Well, there's no real catalyst tomorrow. So no. So I look at it and say, we can get rallies above the 5-day moving average, but if the 5 is declining, it's guilty till proven innocent. As it starts to turn, okay, I'm not going to buy it extended. It pulls back and tests the 5. It makes the higher high here. It was extended. I didn't buy it. And this is when, we're doing our thing at 6:30 Thursday night. And that was Friday. This was, so I didn't buy it, like I said, until here actually, No, I day traded it there, bought it for real here. And now it's still making higher highs and higher lows above the 5-day moving average. My stop is now here. This is the most recent relevant higher or low for half of this position.
Gotcha. Yeah, excellent. All right, I've got 3 questions from X Twitter, 2 serious ones, 1 more funny one. The first is from JT Ticker Monkey. He said, what are the advantages and disadvantages of the different calculation methods for Anchored VWAP? If the ultimate pivot on a gap up is the open, would it make more sense to use the open as the anchor versus OHLC divided by 4 default? Would using the HVC be more effective, or are they also close that comes out in a wash? I know you've got firm opinions on this. Yeah.
It does come out in the wash eventually. The true VWAP, the only true VWAP is a tick chart. Okay, so what we want to do is we want to say, what is the average participant? Not just that first participant where it opened, where it might have traded, the most volume. It's important, similar to the IPO, when you get the first volume spike. But what I want to know is right on that first moment that it moves higher. Well, if I put a VWAP on a 10-minute chart, but we're 1 minute into the day, it's not going to tell me anything at all. Is there's going to be a dot climbing up and down that 10-minute bar. So I look at the 1 minute bar. And when I look at that 1 minute bar, do I want to know what happened in the first second of trading of the day, that opening print? Or do I want to know what happened with all 60 seconds, all the transactions in the 60 seconds? I don't want to know just the open, because that might have been 60% of the volume, a big piece of it, but the other 40% of the volume that occurred during those 59 seconds, those matter just as much. So I look at it and say the most accurate we can get is open, high, low, close divided by 4. Because again, unless we're looking at tick, that's the ultimate, but we're looking at an approximation. The first 10 minutes of the day, I want to look at the OHLC divided by 4 on a 1 minute chart. After 10 minutes, I'll say, okay, now I can switch to a 2 minute chart. I don't need that type of granular. Thank you. 30 minutes into the day, I'll switch it to a 5 minute time frame and leave it there. Unless it's like one of these little 28% ATR stocks, then I'll have that on a 1 minute chart all day long. And I'll be anchoring from that high 45 minutes ago and that low 17 minutes ago. But it's open and high, low, close divided by 4 always for me. That's most complete. And we want to know the volume weighted average price, average of everyone.
Yep. Excellent. We've already touched on the second point, but it might be worth going over again just to reiterate some good points. How do you differentiate between a healthy consolidation around the Anchored VWAP versus distribution that will more likely break down below it?
Okay, that's a great question. I mean, it's similar to what we were just talking about in the SPY, is that, let's just say that this 5-day moving average was a VWAP, just for argument's sake. And we look at it and say, well, it's crossing above and below the VWAP. It's not telling me anything. Well, just the fact that it's crossing above and below is telling you something. It's telling you there's indecision. So you look at the market and you say, well, is there structure here to trade? So again, it says, here's our range that we were in. Is there any value in selling below that VWAP or buying above that VWAP? Is this healthy consolidation? I don't know. We don't, during this consolidation, we don't know. So we can look at stage analysis and say, hey, this was stage 3, this was stage 4. How do we know it was stage 4? Because it made a lower low. And this ended up being stage 1 because we were turning sideways. This is officially where stage 2 began. This could have turned into stage 3 if it did this, right? If it did that, that could have been stage 4. Instead, we're looking at this and saying, some people get hung up on this and say, hey, it looks like a stage 3 distribution. It does, but it could also look like a pause with a time correction, a stage 1 continuation back into stage 2, which it ended up being. So I don't differentiate. I'm not going to beat myself up trying to categorize it. I'm going to wait for the market to tell me, does it want to hold this level? So like buying a pullback, that's why I don't buy the pullback to the VWAP, because it might hold or it might just slice right through it. It's not for me to decide. Again, I don't want to do the dirty work. I want to let other people say, we believe in this enough that we're going to create support in here. And this I outlined on my weekend video saying, if it pulls back down, we want to see how it behaves at the 5-day moving average and the prior resistance. And, someone will tell me, hey, thanks, Brian. I bought it right on the 5-day moving average. That was perfect. Like, well, okay, great. But that was really risky. You were taking, in hindsight, it worked. This is a lower risk entry, I would tell you, because you had this higher low and you had a higher high.
Mm-hmm. Excellent. All right, now for the fun one. I forget who said this, but whoever you are, it's a good question. Is it true that you have only price bays copyrighted and protected and a sniper ready to shoot anybody who uses it without your consent?
Everything except the sniper is true. Yeah, but a client of AlphaTrends who's a retired lawyer, he offered to do this, and I said, "Yeah, that'd be cool. Have a trademark. That's awesome." And he said, "Well, Brian, in order to uh, make your trademark valid, you have to enforce it." I said, "Well, I don't want to be a dick," and but there was like somebody selling coffee mugs with only price pays. He said, "I'm going to send them a letter." So he sent them a letter, and that's part of the file. And so I think there was somebody else that he sent a letter to that maybe had T-shirts or something. So it's 100% true, except the sniper. And but there's a lawyer who's sniping.
There you go. All right, just two wrap-up questions. This has been fantastic. First of all, thanks so much for your time. Other than only price pays, what are some of your other just favorite trading quotes that you want to maybe rapid fire shoot us with? I know you've got so many in your books and all of that, but yeah, what are some favorite sayings or stuff that is true and you want to really emphasize?
Yeah. Simplicity is the market's greatest disguise. That's a play on Michelangelo's simplicity is the ultimate sophistication. And it's true everywhere. I mean, just get back to basics. The coaches will always say, we got to get back to basics. We got to get back to basics. We got to run the ball. We got to do this. So that's one of them. I have this little poster with all of them too. We only know support and resistance after the fact. That's a big one. That's why they're potential levels. They're levels of interest. Let's see. What are some of the other ones? There's so many I repeat all the time.
We can show that poster too. We'll add it in posts here to insert for everybody. One last question for you, Brian. What advice do you have for traders watching this that are maybe earlier in their journey, or they just want to kind of take that next step, really, get focused on this, really push the boundaries of what they're capable of? What advice would you have for traders who, want to improve at trading and really get going?
Okay. Product promotion time. I don't have mine up like Richard's, but start with these two books right here and focus on the simplicity. If you're less than a year in the market, don't buy this yet. Go over to this book. Understand market structure first. Understand the fractal nature of market structure on all time frames, and just don't overcomplicate it. Use some simple things. Have a pet indicator, maybe two, maybe it's the MACD, the RSI, or whatever moon cycle it might be, but focus on, and it's trademarked because, only price pays. The rest of it, this market now, oil's over 100. The market's supposed to be going down. It's up on light volume. Breadth is deteriorating. It's supposed to be going down, but the market does nothing but go up. Don't argue with the market. Look at the market and manage risk.
Excellent. And I'll add your YouTube channel, fantastic resource, your website. And, we've done a lot of, a couple interviews as well that, if you really enjoyed this one, really recommend watching those, because we dive into your routine, all that stuff, different aspects that maybe we didn't cover as in depth today. So I'd recommend watching those. And you've done a lot of other tremendous interviews as well. So yeah, that's it. Brian, thank you so much for taking the time to be here. I always enjoy speaking with you. I always learn something new. And just like that simplicity quote, I think you explain things in a very, coherent way that really resonates with people. So thank you so much for educating others and for being a part of this, writing these books and all that. So thanks for your time. To everybody watching, I hope you guys really enjoyed. If you're sticking with us into the end, comments, what should they comment down below? Anchored VWAP? Sure. There you go. Comment that down below so we'll know you're a true fan. And thanks so much for watching. Leave a like down below if you enjoyed. Subscribe if you're new to the channel. And we'll see you guys in the next one. Thanks. Cheers.